All right, welcome back to class. This ratio analysis, it's a common topic in majority of your courses, including the PM, FR, XBR, and PSAF. So it's the same ratio anywhere, anytime, the same ratio. The only thing I can change is that of PSAF. I can change small. I can change small. But for FR, XBR, PM, whatever course you are doing, ratio is ratio. Ratio is ratio. So what I'm going to be doing in today's class is explain what ratio is, give you the classification of ratios, then explain the types of ratios, give you the formulas, and then I have two solid questions here directly from your icon, past questions. This is a number one question in 2017, and this should be around 2014. So I'll just pick these two and do justice to it quickly. So, but before we do that, let's talk business. Let's address what ratio is. Now, this topic does not require too much talk. One, because you have been doing it from secondary school or university, wherever you started doing it, it's a very common topic. All right, so it doesn't require too much talk. And if you are listening to my class, you don't have a pen and a book. That means you have not started because you have a lot of formulas to jot down. So there's nothing like you are putting it in your head. So please ensure that your calculator, pen, and book is with you so you can listen to this and understand vividly. So what is ratio first? So a ratio is simply one number expressed in terms of another number. Okay, to show the relationship between two numbers. It's as simple as that. A ratio is used in showing the relationship between one figure and another figure. So if you want to know how related two numbers are, what do you do? Use ratio to analyze it. It's as simple as that. So for accountants, we can decide to show the relationship between assets and let's say equity, or we can decide to show the relationship between stock and let's say for example receivable. So whenever we want to show relationship between two values, two variables in the financial statement, all we need to do is to use a ratio in analyzing it, and that is it. Okay, and that is it. It's as simple as that. Would I can ask you to define ratio? Never. I don't think so. So nobody asks you for that. But what they can ask you is the usefulness of ratio. Is the usefulness of ratio. Now let me give you one particular thing before I continue, right? Now, I want to explain how profitable, okay? I want to explain how profitable Dangote is or how rich Dangote is compared to who will I use now? Who will I use now to match this comparison? Okay, Dangote and I don't use $10 is my guy. Okay, let me use Solomon. Dangote and Solomon. Please, it's not King Solomon. So I'm using that. I want to compare the wealth of Dangote and Solomon. I want to compare the financials of Dangote and Solomon. So this is how it works. So if I say that Dangote's total assets, total non-current asset is 10 billion, okay? And I want to talk about Solomon. I can now say that Solomon's net asset is only 30% of Dangote's net asset, of Dangote's assets. What does that mean? That 30%, how did we get it? It was like a ratio that was computed back end for us to get 30%. So rather than saying that Dangote's total asset is 10 billion, then Solomon's total asset is 6 billion. We just use a percentage to represent it, or we just use a ratio to represent it. Just like saying that 10 Dangotes equals to 1 Elon Musk. That idea alone, that statement alone is in financials, it's ratio. So rather than telling you how much Dangote worth and telling you how much Elon Musk worth, what they just did to say 10 ratio 1, it means 10 Dangote equals to 1 Elon Musk. It's as simple as that. So rather than me telling you that I'm going to increase salary by 15,000 naira for everybody this month, I will just say salary will be increased by 30% or by 15% or by 20%. So it's a terminology that people use without even knowing. Okay, without even knowing. You don't want to tell somebody how much you earn. You can say that your salary is 30% above the minimum wage, or it's within the range of 30 to 50% above the minimum wage. All those things are ratios. Okay, they are ratios, they are indices. So we can use ratios to compare or to measure the relationship between one value and another value. That is why sometimes when you hear some expatriates talk, like economists, you see them using indices. Okay, the market this is 25%. Why didn't they tell you the actual amount? The inflation rate rose by 5%. Why didn't they tell you how much is the inflation? So everything is indices. So we as accountants, when we talk, we use ratios. We must have computed from our back end. We don't want to say the figures directly. We use ratios. Okay, let us take an example now. When we are doing working capital, we talked about receivables, receivables payment period. Abi, the number of days it takes us to receive money from our receivable, isn't it? And we gave what? We gave answer. We say 13 days. We say 14 days. Why didn't we say that the debtors will owe us 6 million for 3 days, but they'll pay us they'll pay us 3 million out of it. Then for the extra days, they will not pay us the 3 million. We don't have time for all those ones. So what we just do to calculate the average? We say on average, debtors make their payment within 13 days. That is a ratio. That is a ratio. How long does it take us to pay creditors? Rather than saying anytime we buy from our creditors, if the amount is less than 10 million, we are going to split the money like this. We'll pay 3 million first, we'll pay another 2 million, we pay all those ones are bandadash. Financial analyst does not behave that way. So what they just say is they will just say on average, when we acquire goods from creditors, it takes us what so days on average to pay them. These are ratios, these are how it works. Many of you that are head of account that are pursued to be at board meetings at the end of the year or annual general meeting, go and listen to the way, the way your auditors speak. Go and listen to the way CFOs they speak. We are going to hike revenue by 20%. We are going to reduce cost of sales by 3%. We are going to do this by percent, by ratio, by percent, by ratio. Why are they not calling the actual amount? That's what you need to ask yourself. So ratio is an index, okay? It's an indices, okay, that is used to measure the relationship between two values. And many financial analysts, many professionals use those things to communicate while having what speech or while having discussion. So now let's look at the ratio and the usefulness of ratio. Number one, we say that companies' ability to meet its current obligation. Ratio are useful in dimension of the company's ability to meet its current obligation. So we can use ratio to determine whether a company can meet its current debt. That's when you'll be looking at current ratio, isn't it? Current ratio. We want to know whether we have enough money or we'll be able to meet up with the loan or with the expenditure that we have. Now, what baffles me is that after teaching all these things, accountants do not apply these things personally within themselves. It's only when they get job that they will go and apply it. It's only when they got job. I'll give you a practical example. Somebody met me, that was early this year. It was a woman. She owns a restaurant and she says that where she is, there's no light, and that if she can get a solar panel, get solar inverter, whatever, that she can be charging phones. People are already asking her. So people will come. So people usually go to the beer parlors or go to all these restaurants and can tell this come up outside, but it's a big shop where they usually have lights. That she cannot be blowing generator of money till evening. Those people usually have light. I said, okay. So I said, how much is this inverter we're talking about? Everything for that inverter is over 3 million. It's over 3 million. I said, okay, that's fine. 3 million is not a bad deal. She now said if she wants to pay outright, I think she will pay 2 million. But if she's paying in bits, she will pay 3 million plus. The interest alone is over 1 point something million. Then I asked her, how much do they charge phone in that area? She said, phone like 100 naira, 150 naira. I said, okay, no problem. On an average, how many phones can you charge in a day? She said, for now, like, I used to have like 5 people that will come and give me phones, 7 persons that will come and give me phone. I said, okay, no problem. I said, okay, no challenge. After I asked her all the questions, I realized that even the years given to her to pay back that inverter money of 3 point something million, she will not be able to meet up. She will struggle. She will use her food money to pay for that inverter. And this is an asset that it wants out. It's not like after the 3 years, you can now say you want to start enjoying it. How many lives is the inverter itself? It's only lithium that has longer lifespan. And with the way these people are duplicating batteries these days, you cannot even tell. So after I did the analysis, I told her that it is better you run your gen for now. Because even the 3 million, you don't have it. It's still loan. You want to go and loan the 3 million. And if you loan the money, you will pay interest there. And you also pay interest for the inverter people. How many people will come and charge for? Even if you have 100 people that come and charge for 100 naira, 150. What are they charging? What money will it give to you? So all these things, you can analyze it for your client, for somebody, using ratios. So if you want to know a company's ability to meet its current obligation, carry out current ratios on it. It's as simple as that. Carry out current analysis on it. And the next one is the extent to which company has used long-term solvency by borrowing funds. You can use a ratio to analyze these too. Is my company highly financed by debt, or is my company highly financed by equity? Instead of it to say the equity is 10 billion in Dangote and the debt is around 6 billion, it's ratio you will use. You can tell them that the ratio of debt to equity is to the ratio this, or is 60%, or is 30%, or is also amount. You use ratio to explain it. The way medical doctors talk using their own jargon, yet to come and use your jargon using ratios and confuse them. Then if they need further explanation, let them pay for consultancy fee. The next one is that the efficiency with which the company is utilizing its various assets in generating sales revenue. If you want to know how well an asset is being utilized in generating revenue, you use ratio for it, efficiency ratio. When you were doing your FRO and XBRO, you were told that assets are bought to generate revenue. But ratio will help you to determine how much revenue an asset it generates. That is what ratio will do. Then finally, the overall operating efficiency and performance of the company can also be analyzed using ratio. Go and ask audit firms now. Whenever they audit they prepare your accounts for you. Okay, whenever they prepare accounts, in case you call them to prepare accounts for you, they will always do some little ratios like EPS, earnings per share, market price per share. They'll do all those analysis for you down. So you can use that to make certain decisions. Go and ask CFOs. Okay, as at the end of the year, once they are done preparing account, management account, they do a lot of ratios down so that the shareholders or users of financial statement can use those ratios to analyze the business. And that is it. So that is all. So let's move to the calculation of ratios. This is where you need your pen and your distance to just formula. Okay, so we have classification of ratios. We have ratios and short-term solvency and liquidity ratios. Then we have long-term solvency and liquidity ratios. We have efficiency and profitability ratios. We have potential and growth ratios. These are the classifications. Under each classification, we have types. Okay, so for the first one, we talk about short-term solvency and liquidity ratio. All right. Now, under short-term solvency and liquidity ratio, what are the ratios that we have? This ratio, this ratio includes current ratio, acid test ratio, also known as quick ratio, also known as liquidity ratio, stock turnover, debtors turnover, debtors average collection period, creditors turnover, creditors average payment period. Please, these are the examples of ratios under short-term solvency and liquidity ratio. And somebody wants to ask me, must I know that these ratios are under short-term solvency and liquidity ratio? Yes. Yes, you must know. Because sometimes the way the question will come in your exam is calculate or prepare 5 ratios under the following heading. A, short-term solvency and liquidity ratio. Short-term solvency and liquidity ratio. So if you don't know the ratios that are under short-term solvency and liquidity ratio, how will you compute the ratios under it? That's the most difficult way that this question can come in ratio analysis. When I can list the ratio for you to compute, life is sweet and easy. But the moment they say you should compute the ratio under these headings, it means that you must know it. You must know it. So please, these are the examples. So we're going to take them one after the other, just picking their formula. They just pick their formula. So for the current ratio, please, the formula is current asset divided by current liability. Formula is current asset divided by current liability. So in ratios, you have to calculate and you also have to interpret depending on the question. Okay, depending on the question. At skills level, more of what they want you to do is to calculate. At professional level, they don't just want you to calculate, they also want you to interpret. So that is why we have the interpretation here. So it indicates the ability of a business to meet short-term liabilities as they fall due out of its short-term assets. That's the interpretation. So when you say current asset divided by current liability, what it's trying to tell us is, can your current asset pay for your current liability? Can your current asset pay for your current liability? You are that kind of person that works and you earn 500K at the end of the month, but you have one woman you usually collect provisions from, and the woman will wait till you collect salary. As you are collecting, what are you doing? You are monitoring what you are collecting. So you will not end up collecting 700 and your salary is 500. You carry all your 500 and go and give the woman. Then you will still be owing her 200. So that is what is happening here. Your current asset, which is your salary, which is current, meaning that it is it happens all the time. It's current. It's within 1 year. This is your current asset for 2020 for January or for March. Can it meet up with your current liability? The debt you are owing that woman that you are collecting Indomie. That bookie that you are going there every night to go and do Indomie and egg. They'll put carrots and they'll give you tea. And they'll wait the end of the month before they pay, before you pay them. Can you pay those money from your current asset, from your cash? That is what this is trying to measure. Many analysts say that the standard ratio for current ratio should be 2:1. Please, this is just an assumption. Okay, it is just like a benchmark. It is not always the case. Current ratios are usually analyzed based on the industry. You cannot say that the standard ratio for current ratio is 2:1 in all industry. It doesn't work that way. Okay, just the benchmark on average, it should be 2:1. This means that your assets should be what? To be able to pay for your liability 2 times. That's what it means. So the 2 refers to current assets, the 1 refers to current liability. So your assets should be able to pay for your liability at least 2 times. And that makes sense. In some industries, it is 3:1. You should be able to pay for something 3 times. Okay, you have heard of financial analysts speak. They say if you want to get a car, if you don't have ×2 of that money in your account, don't buy the car. It's not like you'll be saving, I want to buy a car. And the moment your money complete 10 million or 9 million, you pack everything to go and buy a car. To fuel this problem. Small problem with the car now, you don't have money to repair. You begin to look for who you will sell motor to. So sometimes when you want to buy some things, ensure that the money you have in your account can pay for that thing 2 times, at least. If you are done, at least 3 times. Makes sense. And the next one is liquidity or quick or passive test ratio. The formula is current asset minus stock divided by current liability. So this stock is closing stock, please. Okay, it's closing stock. Closing stock. So the formula is similar to your current ratio. The only difference is that stock was subtracted. And the reason why stock was subtracted was because in some industries, stock is not a fast-moving item. Stock is not a current asset. That's what it means. In some industries, stock can last in a particular warehouse for years without being sold, e.g. cars. You can have one car in your garage for 2 years, 3 years. It is not moving. Nobody's looking at it until one day that you sell it. So we have to take out stock on the assumption that stock is not a current asset, it's not fast moving, and we divide the balance with your current liability. It tends to measure the same thing that your current ratio is measuring, but this times using the most liquid asset. Okay, using the most liquid asset. And when you take out stock on current asset, every other asset is what? Is liquid. Okay, more liquid. So the next one is stock turnover. Stock turnover. So take the formula: cost of sales divided by average stock. Cost of sales divided by average stock. So this measures, this indicates the velocity in number of times per period at which the average figure of trading stock is being turned over, that is sold. The word turnover means sold. When you hear the word stock turnover, stock sold. So what is the frequency of time that stocks are being sold? Basically, cars have low stock turnover. Industry like cars, they have low stock turnover. All this gold, they have low stock turnover. You understand? The only people that buy gold is me, Davido, Burna Boy, Whiskey. They also put now one, maybe Rema. You understand? They are buy good gold, though. It's not the one that people are wearing, you know. So all those ones, they have low stock turnover. Yes. But you see things like fast moving commodities, FMCGs, this what do you call it? Just right, the models people, their turnover is very, very high. You understand? Those guys don't make money when they sell one. They make money when they sell, frequently, when they have high stock turnover. People coming there to buy. That's not stock turnover. When you stay in your shop in a day and only 3 persons came to your shop to buy commodity, on average, you only have 3 turnovers. Okay? Turnover is low, 3. But when you are asking this person, another person is coming, you've not even started for that day, you have a very good turnover. So the number of times that stock is being turned to money. Okay, that's what I mean by stock turnover. Then the next one is debtors turnover. Debtors turnover. Debtors turnover. So for debtors, you say credit sales divided by debtors. Okay, credit sales divided by debtors. So first, before I talk about this debtors turnover, please come back to this stock turnover. Cost of sales is easier to find this in your P&L. Then your average stock is going to be your opening stock, okay, plus your closing stock, and then you divide it by 2. That's how we go about it. Okay, so your opening stock plus closing stock divided by what? By 2. So this particular stock turnover, that's how you get it. Therefore, debtors turnover, credit sales is easier to identify it. Now, pay attention. Some questions will not give you credit sales, they'll just give you sales. So pick the sales like that. Assume that the sales is credit, okay, except otherwise stated. Then your debtors, you know how to get it now, direct. It's in your balance sheet. So what this ratio does is that it picks figure from P&L and it also picks figure from balance sheet. So it makes use of the two basic financial statements, okay, to prepare the ratio. All right, prepare the ratio. Now, the number of times, this measures the number of times debts are turned over. The higher the turnover, the better the liquidity of the company. So when you say debt are turned over, it's not like you are saying that debt are sold, because I told you that turnover means sold. It's not like you are saying that debt are sold, but debts are being converted to cash. Let's put it that way. So if your debtors are paying you more, okay, you understand? As they are owing you, they are paying you, they are owing you, they are paying you. It means that you have a good debtors turnover. And what happens is that you get more money. It's not the one that they will hold you. You will preach, you will preach, you will preach, you will preach. You will put them in prayer points before they pay you. That one now, you have a very low debtors turnover. What is going to happen? You yourself, you may run out of business. Does that make sense now? So that is debtors turnover. So let's take a few more. We have the average collection period. For those of you that stayed with me for, what do you call this? This working capital. You know this. So your average collection period or your receivable collection period. The formula is debtor divided by credit sales. And I told you for the credit sales, it's the same thing as the normal sales, all things being equal. Okay. So this one measures how long it takes your debtors to pay you. So rather than you saying Rufus Limited that usually buys from us, if that guy usually pays in 3 months, Basmi PLC that usually buy from us, that guy will take like 5 months to pay us. You are not a professional. But the moment you say that your average collection period for your debtors is so days, it means that you are a professional. Who is asking you to begin to list all your debtors and begin to tell us the number of days that it takes each of them to pay you? We don't have time. Information should be concise and straight to the point. So give us what we need to hear. Average the figures. Many of the things we do in accounts, finance is average figures. Economics is average figures. Who told you that inflation rose by 25%? It was only the average figure. Then let's go on. We have creditors turnover. The formula is credit purchases divided by creditors. Who will tell you credit purchases? They may not give you credit purchases. Just use purchases like that. And sometimes they may not even give you purchases. Use cost of sales, because purchases is inside cost of sales. Okay, but look for purchases first in the question before you begin to take other options. Does that make sense now? So the opposite of average collection period for debtors is creditors turnover. Okay, this indicates the average period for which it takes debtors to pay. This should be creditors. Don't mind them. I'll write to the owner of this book. Let them change this thing. So the opposite of debtors turnover is the creditors turnover. That's what I was trying to say. Then we have the creditors average payment period. Okay, we have the creditors divided by credit purchases. So this indicates the average period for which creditors remain what? Unpaid. How long do you hold your suppliers' money before you pay them? That's your creditors what? Payment period. Okay, that makes sense. The next category, which I'm going to be very, very brief on this. Okay, the materials available, you can read it. Is your long-term solvency and stability ratio. For your long-term solvency and stability ratio, we have the long-term debt to shareholders fund. Okay, long-term debt to shareholders fund. The formula is long-term debt divided by shareholders fund. Long-term debt divided by shareholders fund. This shareholders fund is equity. Okay, equity only. Equity. All right, equity. The next one is total debt to shareholders fund. Okay, total debt to shareholders fund. You know, this long-term debt is divided into short-term and long-term. So for the long-term debt to shareholders fund, they have only captured the long-term debt. Okay. Then for the total debt to shareholders fund, you're looking at total debt, which means both long and short term. Add your current liability on your long-term liability together to get the total debt. That's what it means. For this long-term debt, is only non-current liability that you want. Makes sense, Abi? Then this guy is always tested gearing ratio. See, there are different formulas for gearing. Okay, there are different formulas for gearing. It just depends on the availability of information. Okay, so one of the formulas for gearing is fixed interest capital divided by equity plus reserve. You can jot that down. Fixed interest capital divided by equity plus reserve. Or you say fixed interest capital divided by what? Equity plus fixed interest capital again added to it. It all depends on the availability of information that you have. Okay. Good. So this fixed interest capital, what does it mean? You know, or like all these debentures, all these loans that their interest is fixed. No matter the profit you make, you are paying the same interest on it. Like debentures, long-term loan, they are fixed interest capital. Now, what is the interpretation for gearing ratio? Gearing has this standard of comparison. Gearing is saying that if the answer you get is above 50%, then we can say that the company is highly geared. But if the answer you get is below 50%, we can say that the company is what? Lowly geared. That's what it means. So when you hear lecturers say highly geared, it means that the gearing is above 50%. The business is more financed with debt than equity because gearing measures the relationship between debt and equity. Okay, it tells us how your business is being financed. Is it more of debt, okay, or equity? So when the gearing is above 50%, it means that the company is financed mostly by debt. And if the gearing is less than 50%, it means that it is what? Lowly geared. It is financed with low debt. Okay. All right, then the next one is proprietary ratio. Case study students will see this. Yes, this is also for case study students. Case study students would have seen this a lot in their solution, the one I gave to them. So what do we have on that gearing ratio? We said what? All right, so we said tangible assets divided by shareholders fund. Okay, any answer you get here will be in figure if you're using this formula. But if you're using shareholders fund, if you turn it upside down, shareholders fund divided by tangible assets, any answer you get will be in percentage. Okay, any answer there will be in what? Percentage. Then finally, we have fixed dividend cover. Okay, fixed dividend cover. This one, you're using your PBT, your profit before interest and tax, divided by fixed interest. Okay, so this one just tells us whether your profits, okay, that's how I call it profit before interest and tax, whether your profit can pay for the interest. You understand? You know, when you're preparing your P&L account, the idea is that you get profit before interest and tax. You will not suffer interest. You will not get profit before tax. You will not suffer tax. You will not get profit after tax. So the idea is that interest is usually paid to people that are giving you money. So first of all, the accountant wants to know, do we have enough profit to pay off the interest? For him to be able to determine this, there's a ratio that he can compute. That ratio is known as fixed dividend. So this should be fixed interest cover, not fixed dividend. We have fixed dividend cover. We have fixed interest cover. This man will hear from me. He will hear from me. Barrister, I don't know whether you are here. He will hear from us. So profit before interest and tax divided by fixed interest. That is dividend. It's now the profit before interest and tax all over what? Fixed what? Dividend or all over dividend. Does that make sense now? So this should be what? Fixed interest cover. We want to know whether our profits before we pay interest and tax can actually pay for our interest. That makes sense. Okay, that makes sense. So the next category is efficiency and profitability ratio. Efficiency and profitability ratio. Please, am I clear? Am I audible? Somebody is saying my voice is low. I don't know. Okay.
So yes, Dr. President, it was low. It was not stable.
Are you the one that sent that message?
Yes, please.
Another person need to confirm.
No, it's very low. I had to use the earpiece. It's low.
What about now?
No, it's okay.
It's better now.
Okay. Okay. All right. Thank you. All right. So what do we have now? Efficiency and profitability. So for efficiency and profitability ratios, here are the ratios that we have for efficiency and profitability ratios. This is one of the most commonest ratios. Everybody knows this one. Even that child that they born in loot, that is not crying, he knows this ratio. So it's not a big deal. So for the types of ratios under it, we have the net profit to sales. What is the formula? What we call net profit to sales, the same thing as net profit margin ratio. I guess in our net profit margin ratio. So the formula is net profit divided by sales times 100. Everybody knows this one. They will clap for you. Get your net profit, get your sales. This ratio only uses values from your P&L. From your P&L, okay? That's your net profit margin ratio. Then this is your gross profit to sales, or your gross profit margin ratio. So just say gross profit divided by sales times 100%, and that makes sense. All right. The next one is return on capital employed. Rules. Everybody knows this. Net profit divided by capital employed times what? Times 100. What is capital employed? When you are giving your financial statement, what will be capital employed? The capital employed can be share capital only, okay, or share capital plus reserve, depending on how the question comes, okay. Or if you have long-term loan, add the long-term loan to the share capital and reserve. If you have current liabilities, then you do Share capital plus reserve plus long-term loan plus what? Current liability. That's your what? Capital employed. Anyhow you want to look at it. Then we'll be saying average capital employed, opening capital employed, and what do you call it? Closing capital employed. When you are giving a financials, when you are giving balance sheet and P&L, and you are computing this ratio, look for your equity component. All these things are equity and liability components. Okay, that's your capital employed, equity and liability component. Then pick them. Once you pick them, that will be your capital employed. Makes sense. Okay? Then the next one is going to be your asset turnover. Your asset turnover, where you have sales divided by capital employed. You already know what capital employed is. Okay? I hope you are jotting those formulas. So when we start solving, I will ask you for the formulas. All right, then we have expense to sales. Now, this expense to sales can be admin expense to sales, petrol to sales, salary to sales, any kind of expense. You can show it as a ratio to sales. But the fact that they put expense here just like a generic word, so you can actually pick the particular expense that you want. So for this student, this will be a very good task for you. You can decide to express salaries as a percentage of sales. You want to know how much of salary is inside of sales or what portion of sales can pay for your salary. You can decide to express maintenance expenses as a percentage of sales. So just think of any expenses in your mind and express it as a percentage of sales. I usually do this in reporting. If I want to know the expenses that hit more from our sales, sales is like revenue. So that expenses that hit more from our revenue, you can just divide all your expense by sales, and the one with the highest percentage shows that this expense is very, 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 very high compared to sales. So we need to tame it, we need to control it. That's what we do here. So this can be anything. So this can be anything. It can be admin expense, distribution expense, maintenance expense, payroll expense, or any kind of expense. Just put the figure up and divide it by your sales, and that makes sense. All right, so the next one is going to be stock holding period. Stock holding period. You see, when you hear the word period, it therefore means that it needs to be measured in days, weeks, months, or years. We have the average stock divided by cost of sales and 365 days. What it cannot be 365 days in your question, it can be 366. It can be 360. I can have the power to change the number of days in the year. So don't say that I gave it 365, it must be 365. Watch out whatever the question wants you to use. Makes more sense. All right. So let's go to the next one. The material is already shared now. Who is asking for material? The next one is potential and growth ratio. Potential and growth ratio. All right, potential and growth ratio. SFM students, marry this. SFM FM students, marry these ratios. Marry these ratios. When we are doing business valuation, or if you are watching my business valuation video, you will see most of these formulas that we manipulated, that we use there for business valuation. So please take note of this, SFM students. All right, so the ratios measures, this includes what? Dividend per share. Okay, so how much dividend is somebody earning for one share? So the formula is what? The dividend payable divided by the number of ordinary shares. Okay? So dividend payable simply means the amount of dividend that we want to pay. Then we'll divide it by the number of shares. That will give us the dividend per share. Then what about the dividend cover? The dividend cover. We want to see whether our profit can cover up our dividend. So we'll say profit after tax, because dividend is always paid after tax. It's paid after tax. So we have to say profit after tax, not profit before tax. So we say profit after tax, and you divide it by what? Your dividend payable, the amount of dividend that you want to pay. All right, the next one is going to be earnings per share. This is one of the most popular ratios used by auditors whenever they are preparing accounts for you, or by compilation officers when they are preparing accounts for you. EPS, earnings per share. In your financial reporting XBR, you will do EPS on its own. You address the complexities that comes with EPS. So what's the formula? The formula is profit after tax minus preference dividend. All right? Then you divide it by the number of ordinary shares. Ordinary shares. Okay, the material is not in some group. I don't know what. You get it. I'll share again. So the number of issued share. Okay, so that's the formula for EPS. Profit after you paid tax. Okay, take out your preference dividend. Okay, and then whatever is left is the money remaining for ordinary shareholders. That is why you are dividing it by the number of issued ordinary shares. Please let me confirm, is the voice now audible before I continue? Is it now good? Okay. Earnings yield. Earnings yield. Earnings yield. When you hear the word yield, anytime you are saying yield, just know that market is involved. Market is involved. So earnings yield, you are talking about earnings per share. So you must have calculated your EPS before you can calculate your earnings yield. So your earnings per share has a relationship with the market value. Okay, with the market value. Then multiply it by 100, you get that. Then your dividend yield, your dividend per share as a percentage of what? Market value. That's your dividend yield. And then finally, you have your PE ratio. This one is used for business valuation. You see, everything that I'm talking about here under potential and growth, your business valuation. So this PE ratio, just reverse this ratio. The reverse of your earnings yield is your PE ratio. Okay, so look at it. Market value is up, market value here is down, so market value here is up. Earnings per share here is down, earnings per share here is up. So the reverse of your earnings yield gives you your price earnings ratio. Shikena, that's all. The last part that Python would not forget to set, okay? The last part that they will not forget to set is your limitation of ratio. As powerful as ratio is, it has its own limitations, right? It has its own limitations. Let's look at some limitations of ratio. Now, let me just pick some from my head before I check. Now, one, you use ratios to interpret financial statements. Let's assume that we interpreted the financial statement of Dangote, okay, using ratios, and we also interpreted the performance of Lafarge using ratio. Both of them are both cement companies in the same industry. So what happens is that some people may think that, oh, that means that is to say we can compare their performances. It is not always the case because accounting policies may differ. Okay, the accounting policies used by Lafarge may be different from the accounting policies used by Dangote. So for the fact that they are in the same industry does not mean that if you compute their ratios, you can actually cross-compare their performance. I'll give you one realistic example. You know, when we are computing for this guy, when we are computing for Rose, some people call it Rose, return on capital employed. What do we say about capital employed? We said capital employed can either be share capital only, share capital and reserve, share capital reserve and long-term loan. So it depends. What about if Dangote makes use of share capital and reserve? What about if Lafarge makes use of share capital reserve and long-term loan? How do you compare these things? It doesn't match up, right? It doesn't match up. So sometimes, okay, comparison may be difficult because of the different accounting policies used by the organization. Now, another limitation of ratio is that industry limitation. Okay, industry limitation. You cannot be comparing the performance of Tesla with the performance of Dangote. Despite the fact that you use ratio to analyze Tesla, you use ratio to analyze Dangote, it does not mean that you can compare both. Tesla operates in a different world. Dangote operates in a different world. Okay, they are both different persons, different organizations from different world industry. That would be another limitation of ratio. I don't know if I'm making sense. Makes sense, Abby? Okay, so that is it. So look at it. Many large companies actually operate in a number of different divisions in quite different industries. So industries can make it different. For those companies operating in the industry, it is difficult to decide on the proper basis for comparison. Yes, that is it. So when you are in a particular industry and you prepare your ratios, the first thing that comes to your mind is who do I compare this ratio against? That's what comes to your mind. Just like saying that you are in class, okay, and results, you did an examination, results came out. You say, who do I compare this result against? Or what do I compare this result against? So if you score 80 to 100%, it therefore means that you are comparing it against the grading system. What is the grading system? For Pathfinder, it is A. Maybe your school is 70, I don't know. Ours is A. So 80 to 100 means what? A. So you know that when you get any figure between 80 to 100, it is what? A. For I can say if you get any figure from 50 to what? To 100, it is pass. So you are comparing your grade against what the grading of what? Of ICANN. So the same thing happens for ratios. When a company CFO has prepared ratios, what do I compare this ratio against? Now, there are different ways you can compare ratios. Number one, you can compare ratios against similar organizations in your industry. Similar organization in your industry. So Lafarge, all things being equal, can compare his ratio against Dangote. Dangote, all things being equal, can compare his ratio against my own cement company. Okay, so that is how it works. Then another way you can compare ratio is against industry average. Against industry average. Industry average. It means what is the average in that particular industry, okay, that you exist. Okay, what is the average in that particular industry that you exist? The challenge that we have in this case here is how do we determine industry average? So the simplest way to go about it is they usually use bigger organizations in that industry to form the industry average. Okay, just like saying if you want to compare audit firm now, you say against the big fours. Is it up to the big fours? If it's not the big fours, now you cannot get. You don't want to hear. But you are forgetting that there's the big 10. We still have people that are big, but they are not to the big fours. So if you want to compare, like say the big four, if you want to do any accounting certification, I say, yeah, I can. You see now, you're compared against what? One of the biggest in the industry. That is how it works. Oh, here the work, like say oil and gas is in the big fours. You know, big four and oil and gas. Big four is not just for accounting firm. So in case you think that big four is just for accounting firm, it's a lie. We have the big fours in oil and gas, and my company is part of it. Chevron. Am I making sense now? Shell is part of it. Yeah, I think there's one that is very big too. Forgetting that guy. That guy is not doing me well. So that is it, my brothers, my sisters. That is all. That is all. That is all. That is all. Take other ones. Take other ones. Okay, take other ones. And those are the limitations of the ratio analysis. So let's stop here and entertain any question. Then after that, I will address these simple questions here. Any questions so far, please?
Hello, Mr. President.
Yes, sir. Go ahead. Please.
Good morning.
Yes, sir.
Please, mine is not a question. The material is not shared on the SFM group.
I will do that. I will do that. You need it now?
Thank you.
Or maybe after
If you can send it, it will be fine. If you cannot send it, maybe after the class.
Okay, I will do that. Okay, so that means every presentation here is clear, Abby. I can proceed. That's the problem we have with Nigerians. So when you elected your president, it says everything. Now,
yes, you can proceed, sir.
All of us, we are reaping the dividend now. The anything that they want to do, let them do. Thank you very much.
Dr. President.
Is that a question?
Hello, sir.
Yes. Okay.
A question and not a question. You just said nobody is replying. So, sir, I would like to say, if the material, just like what Mr. Victor said, I don't know if it's possible to share it now, because when you were going through it, I was writing at the point I had to stop because we were fast. I understand you're trying to be time. You can share so I can follow you when the questions are being solved. Thank you, sir.
Okay. Okay. I'm sharing the note now. Okay, this note. PM student already has it. Okay, I'll put it on the association.
Hello, sir.
Okay, sister, go ahead.
Hello.
Go ahead, sir. Go ahead.
Okay. Good morning, sir. Please, sir, your voice usually goes down at the point in time, then it also later goes up again. So at that time, you don't usually get your message at that time, sir. I don't know, probably it's network or your devices, sir. Please, sir.
That thing, I don't know, because I had a class. Was it yesterday? Somebody was saying the same thing, but the other students were saying that they can hear clearly. So sometimes even me, I'm confused. I've changed different jackets and what do you call it, headsets and the likes. It's still the same thing. So I don't know whether it's affecting everybody. If it's affecting everybody, then maybe it may be network. Maybe network. But just let me know. I will always adjust. Just let me know. Maybe you can use the chat box to let me know. I will adjust. Sorry about that.
Okay. Yes, sir.
So I think I sent it so everybody can see it from the presentation group. All right. Okay. Let's do justice to this. I want to see credit average payment period. I've sent the material now. You can use the material to do that. Whoever is asking that. All right, so let's see what we can do quickly. Let's see what we can do. This question is November 2014, question 3. So please jot it down. Part of what we'll be looking at. November 2014, question 3. Let's forget about this whole story that they're telling us here. Forget about this. Let's come and see the requirement. So they said, compute the following performance indices. You know, when I was defining ratio, I said it's an indices. It's an index. So compute the following performance index for both companies. So I think we have two companies here. Okay, Purity and Benchmark. Okay, that makes sense. Number one is to calculate our profit margin, asset turnover, return on capital employed, current ratio, debt to equity ratio. 5 marks. This is embarrassing. 1, 2, 3, 4, 5. Okay, 5 marks. But you know you cannot joke with 5 marks in your exam. Okay. So let's do something in regards to this. This is very simple. Now, in case in your mind you are trying to ask and say, will they give us the formulas on the exam day? The answer is yes. If you check at the back of the question paper, find it very well. It will take you about 4 hours to look for it before you see the formulas. But after 4 hours, you will definitely see it. You understand? So please know the formulas before you enter the hall, unless you're on your own. So let's take question number 1. November 2014.
Sorry, Dr. President.
Yes, ma'am.
Is the class recorded?
Let's leave it, Jare. We should not record. Since the thing is even skipping itself, there's no need.
So we can record, we will manage it that way.
It's recording, no worry. Okay. So let's look at Purity. I have another one that is already recorded on your platform for PM students. Like, you know, but I don't think I solved these questions. I don't know. I think I solved Magifera there. So Purity Nigeria Limited. Now, the first thing you want to do is that if you see a ratio question on normal, it's a very simple question. But the fact that you don't even know the formula is not Italian. It's the formula that will determine whether you know it or not. So since we're preparing for 2, we can just prepare it in a tabular form. Please take note of this. There are questions like Magifera. I can't demand that Magifera be presented in a tabular form. If you go and do a FISI and ignore that tabular form that they say you should use, you will be marked to be deducted. So be very careful. Don't just rush and go and start preparing ratio without listening to the what? To the requirements. They specifically said it. Magifera is not here. It's a ratio question. But the requirement is that using the tabular approach or using the tabular form, prepare the following ratios. What is the tabular form? It simply means just draw a table. You can just say this one should measure serial number. Maybe it depends on you. Then here should just be the ratios. Okay. You understand? Then since I'm preparing for 2 companies, I can say Purity should be here. And I will say, who is this guy? Benchmark, Abi. Benchmark should be here. This is what I can is only asking you to do when they say tabula. So no big deal. So let's start with the first one. The first one is what? Profit margin, Abi. Who can tell me the formula? I've sent the material. So this will be under your profitability ratio. Your performance and profitability ratio. So profit margin, what's the formula?
Over 6 times 100.
I didn't get the first thing you said, sir.
First, net profit over sales.
Okay, net profit over sales times 100 over 1. Okay, so let's go and look for the net profit for this.
Sorry, Mr. President.
Yes, sir.
Yeah, please. I don't know if you have another SFM group. The one I am in, I can't see it there. So I don't know.
Association group.
Oh.
That's where we dropped it. So everybody can see it at once. So Purity Nigeria Limited is a company that produces table water. The company's board plans to restructure its operations with the aim of boosting its market share and profitability. The financial result of Purity Nigeria Limited and Benchmark Co. Limited, which is the leader in the industry, are as follows. Operating statement for the year ended 31st December 2013. Obviously, 20 means what? P&L. No wahala. Then summarized statement of financial position. This is balance sheet. Balance sheet. Okay, that is all. Balance sheet. So please, Let's look at your P&L because your net profit is a P&L item. What is your, what do you call it? What is your net profit?
We can't hear you, sir.
What is your net
We
profit?
can't hear you.
What is your net profit? What is your net profit for purity? Looking at these statements.
1,100.
1,100.
Okay, thank you. 1,100. What is your sales? Looking at this statement.
5.6.
5,600.
Yes.
Oh yeah, just give me figure. This one is not hard. Oh, I'm not enjoying my writing.
That's 19.6.
19.64%. So then we start asking, sir, should I leave it in 2 decimal place? Should I leave it in 3 decimal place? It's not somebody that see food to shop that we ask whether you should finish it or you should not finish it. So you can leave in 2, you can leave in 3. But if the question says leave in 2, they can tell you sometimes that let it be in whole number or in 1 or 2 decimal places. Please obey their instruction. It's simple. The next one is what? 2,530, have you? By 9,430. You can confirm it though.
Yes, yeah, right, sir.
So that will give us how much?
0.26.
26.82.
26.83.
3%. Okay. Which one is performing better and why? Number 2. Which one is performing better and why? This is for
The
professional.
benchmark.
Which benchmark? Okay, benchmark performing better. Why? Hey, problem with deal. Oh yeah, why?
Yes, he has more revenue. He was able to generate more revenue, and also he was able to manage his cost.
Be playing. playing. So that's
The profit to sales is high.
The what?
So they make more profit.
They make more profit
compared to their cost of sales.
Kabosh Kadabash. Zegedege. Igadibash.
Benchmark has a profit of 6.8%.
Benchmark has a what? I didn't get that.
Yeah. Okay. So the benchmark is performing better because it has a profit of 26.8% up to 19.6% of purity.
They're just repeating the percentage for me. Now let's assume that you did not see all this raw data, 1,100 divided by 5.6. You did not see all this raw data. What they only gave to you is 19.64. Just look at this part of my screen. And they gave you 26.83%. And they said, sir, you chattered. You now said yes. You don't know what they want to ask you. You know, you will rush and say yes. And you are chattered. You think they want to give you a job. Then I ask you that, okay, please, can you explain? This is profit margin. Can you tell us, okay, which company performs better? And the main thing is, how do you know that this company performs better? Interpret it professionally. How? Why? I want to know. If that's the only thing that we can interpret today, the rest we don't need to interpret it. But this particular profit margin is common, so you should know it before you say that you finish your Pathfinder and I cannot interpret profit margin. Don't call my name. Do I have case study students here?
Sir, can I try?
Yes, sir. Go ahead, please.
So comparing both, you discover that benchmark has a higher sales than purity. Benchmark has 9,430, while purity has 5,600.
Okay. I said ignore the what makes up the final answer. Just focus on 19.64 and 26.83. Assume that you did not know that the sales was 9,430 and the other person says was 5,600. Just using the final answer only, can you interpret?
All right, so let me try, sir.
Oh yeah, let's go.
Okay, so from the performance on the screen, it can be seen that the profit generated by benchmark compared to its sales is higher than the profit generated by Purity compared to its sales. with the
Yes,
with 26.8.
It means they're able to convert revenue into profit.
Okay. 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 What does 19.64 means? What does 19.64% means? Can anybody just help us? Maybe that way to be easier. What does 19.64 means?
Profit margin.
No. I know it is profit margin. Okay. What does it mean?
Okay, sir.
The net profit to sales.
No. No.
To me,
Is that
for
Angel?
everyone, hello, sir.
Yes, go ahead.
For every 1 naira of sales, we can make a profit of 19.6%.
That man, you use ChatGPT.
That is for Purity.
No, me and you will not agree. Two of us will not agree. If you can confess, you use something. Tell us the truth. Yes or no, I'll buy you something. I'll buy you more. You use something, Abby.
Then also for benchmark also. Hello?
Yes, go ahead.
Yes. So also for benchmark, for every 1 naira of sales, the benchmark was able to generate 26.8% of profit.
That is it. That is the meaning. That is the meaning. Whether you use something or you not use anything to give me this answer, it means that you have gotten this answer now. Tomorrow, if they ask you, you will still get the answer. That is it. 2 persons wrote the exam. 1 person cheated. They did not cash in. For the purpose of that exam, result came out and the person passed. You failed. Which evidence do you have to pass that person? How? That is it. For every 1 naira of sales, the profit inside of it is 19.64%. So if Mark sells 1 naira, they're getting 26.83 as profit inside that 1 naira. If Purity sells 1 naira, they're getting 19.64 as profit inside that 1 naira. So benchmark is making more profit from 1 naira of sales than Purity, okay, making what? Than the profit that Purity makes from 1 naira of sale. No, give me formula for asset turnover. What's the formula? Asset turnover. Thank you very much for that.
Sales over capital employed.
Sales over capital employed. All right, so the sales, we already know this guy now. 5, 600, I mean. This one will be 9, 430. Okay, let me just go up so you can find capital employed by yourself. Should I go up? Who can tell me capital employed?
Ordinary share capital plus reserved plus non-current liabilities.
Thank you. 5,560. Thank you. 5,000. Isn't it? And that other one is what? 9,100. So help me, calculator wise.
$1.01 for Purity.
1.01. So 1.01
no, times 100 is 100.7.
Which one of them?
100.7%.
Okay, so no, this turnover is measured in times, not in percent. Please take note.
Okay, so 1.01.
And this other one will be what?
$1.04.
1.04. So please take note. Turnover is always measured in times. Okay, please go ahead.
And we are not supposed to multiply it by 100, right?
No. 100. Sorry. I will remove the 100. Don't worry. Please go ahead. Somebody is asking a question.
I'm fine, sir. It's about the 100. I wanted to ask about it.
Okay, thank you. So let's do number 3 together. Let's do rows. What's the formula for this guy?
Profit over capital employed.
Net profit over capital employed.
Okay. Capital employed. So this one will be in percentage now.
Times 100.
So our profit is still, we know it now, 1,001 divided by, what's the capital employed? 5560, have you? Times 100. So here will be how much? 2530.
19.8.
91 times 100. Okay. The first one.
Purity, 19.8%.
Next. Somebody should assist her now.
97.8%.
27, I mean.
27.
27.8%.
Thank you. So let's do number 4. What's number 4? Current ratio. Who can tell me the formula for this guy?
Current asset.
Yes.
Current asset over current liability.
Current assets divided by current. Okay, so what's the current asset for purity? Let me go up for you. What's the current asset for purity?
400.
Eh?
Purity 400.
600.
It's not me and you. It's not me and you. 400.
600.
600. Okay.
1,000.
1,000. Thank you. Thank you. Do you guess?
No, I calculated it.
So look at it here.
Okay, 1,000, yeah.
You get that.
100.
Yeah, let's do current liability. How much is current liability?
Sorry.
Who can tell me? Current
1,400.
liability.
1,400.
1,400, Abi.
Yes, sir.
Okay.
Thank God you have not gone for the exam.
200.
Current liability 600.
600.
600.
600.
The current asset for benchmark is 1,000.
Then this one is 500. You get it. So this one, somebody says
14.
divided by 500.
500. For purity, 1.67.
1 point what?
67.
Percent or what?
19%.
I should put it in percent.
So I didn't calculate in percent.
I'm asking you now, what should I do? Somebody is telling me, who is telling me this one?
2.8 times. 8 times.
Ratio 1.
Who said this? Say it again.
6 ratio 1.
Ratio 1.
Ratio 1. That's the way this one usually happens. So it's not in percentage. You put it as a ratio of 1. The 1 came from heaven. Take it like that. Don't ask me that. Where is it coming from? That is the benchmark. It's natural anywhere in the world. Even if you travel to India, it's ratio 1. When I was telling you about current ratio, what did I tell you? I said the standard ratio is what? 2:1. So this 2 is what you have computed here as 1.67. Then just put it as a ratio 1. Yes, go ahead, please. Clean man. Number 5.
Like I'm just seeing something now. This is our capital employee. This is our capital employee. We said the ordinary share plus reserve plus current liability. Put you pick 5. Non-current liability.
Yes.
Okay, understand.
Okay. So let's take the
current liability instead.
Yes,
no,
sir.
it's not
Dr.
current.
President.
It's not current. We cannot use current liability. We use not current. Yes, please go ahead.
Dr. President, please, how will you interpret the current ratio?
Okay, how will we interpret the current ratio? Okay, stay online. Stay online. Somebody will show you now.
All right, sir.
Who is AIT Laptop LLC? Please tell us the answer. How do we interpret current ratio? IAT.
Lecturer.
That's lecturer. Okay, lecturer, please.
Yes.
Yeah, my spirit just called that person. I never knew that I'm even talking to my lecturer. Lecturer, yeah. How do we interpret current ratio? Network is not clear again. Okay, let's use Redmi. I think Redmi has been with me. Who is Redmi 10?
I
don't want to ask the
Good
question. Please help us, Gary. How do we interpret this current ratio?
All right, sir. Purity is able to settle its short-time obligation by 1.67 times. That is, it can pay its liabilities, its current liabilities by 1.67 times. Then also, benchmark can also pay its short-term liabilities, short-term obligation by 2.8 times.
Thank you. It means that if you sell all the current assets of Purity, Purity will pay for all his liability, current liability. You will still have 0.67 of his current asset left. Because if you say 1.67 minus 1, you still have 0.67 left. Look at this bad guy, 2.8:1. If he pays for his liability, if he sells all his current assets and pays for his liability, the Baba still has 1.8% of his ratio of his percent of his current assets still available to settle more debt. So that's what it means in your current ratio. You get? Please go ahead. I'm with you.
Sorry, sir. This 2.8 ratio 1, sir.
Yes.
I would say the guy is prudent because it's like it's not tying down 0.8 in the what's called current liabilities, whereby it can also use that to generate more funds, probably short-term investment. With this 0.8, I just need a clarification in that, sir.
You mean for this 2.8 ratio 1?
Yes.
It means that the guy has more money now. You know, current asset is made up of cash, you understand? Debtors, you understand? Stock, you understand? Bank, you get. So it means that all these things are all sources of money for the business now. It means that the guy has more money than what he has borrowed in short-term basis. Do you understand?
Okay.
What is happening here? So he has more money, just like saying, you know, many of these guys that we usually rate their net worth, it's not like it's the money that they have in the bank alone. Basically, it's their assets. All their assets. If you add everything together, that is their current assets. Then if they not pay the debt that they are owing, they still have more money left. It means that they have more money left to even finance the business without the debts.
Okay.
You understand? So that's very important. It's a very good ratio. Very good ratio. So the next one is debt to equity. Who can tell me this one formula without looking at book?
Debt over equity, sir.
Yes, total debt over what? The total equity.
Equity. Yes, sir. Total equity.
Okay. Okay, so let's look at total debts from this guy's perspective. What's our total debts? So I'll be making use of the long-term debts here of 1,000. And for this one, 4,400. Let me use the long-term debts. Okay. So what's total equity? Who can tell me total equity? Problem deal. How do we get total equity?
4,560.
If you like, go ahead, pay your business. I know that's what you want to ask me. So me, I want to use total debt. But they were open now. They were open. They said debt to equity. So it is long-term debt to equity. That's what it means. So that equity now is the major thing. How do we get equity? I've seen my answer. For purity, how much is it? Who is that? Purity, how much is it?
4,560.
God will bless you. You will marry a good husband. Yes. So the next one is what?
4,700.
Sorry, what did you say?
4,700.
Are you not the one that was asking you to explain something for somebody? I've catch you now. Now you're telling me figure. Okay. 4,700 times 100. Yeah, just give me final answers. We are done.
The first one is 21.92.
Cents.
Yes. 93.62.
93.62. All right, so that is all. 5 marks, all these things. Does it worth it?
No, sir. It's too long.
Okay. Compare and analyze. Okay, please go ahead before we continue. Ask your question.
Sir, please, sir, this 93.68 highly jagged. I don't know if I asked to recommend as way around for this benchmark, what should we keep there, sir, in the exam? It's like a red.
I didn't get your question. You are
I'm saying that this benchmark has 93.662, which means highly jagged. That is, it's more financial depth. So if I ask to recommend what can advise the company so that they will reduce their jarring this ratio, sir? I don't know. Is that what can we tell the company as an advice so that they can reduce this position, sir?
But why do you want them to reduce it? Why is it that it's a bad thing that they have debt? I don't understand. Is it a bad thing?
Well, it's looking like a bad thing actually, sir.
Okay. Let's talk about it. Let's call somebody from the professional class, the SFM people. They should be able to tell us better. Who is SFM? Who is offering? Who is a professional here? Please identify yourself before I call your name. Somebody is asking for advice. He said that benchmark is highly geared, 93.62%. What can we do to reduce the debt of benchmark? So I need an SFM student because it's a question, it's an SFM question. Can somebody talk about it? Can somebody talk about it? I think this favor is professional. My mind is telling me yes. Olamide is here, professional. Mr. Sazua, you are professional. Catch all of that. Sikpa, professional. Abi? Yes.
Sikpa is patient, yes.
Patience, professional. Sorry. Shego. Ishego, I don't know. Are you professional? I don't know. So nobody knows the answer.
Can I try?
Oh yeah, try. Yes, I need answers. Me too, I want to learn.
So for the benchmark, it's their debt to equity, it's high, which means that they have like higher risks, meaning they are maybe operating their company in more debt.
Yes, I agree with you.
Which increases their risks. Sir?
He is asking that how can we reduce the debt?
Sorry, I can't hear you.
He's asking how can we
Sir, can I try?
Wait, barrister, lecturer, wait. The man is asking how can we reduce the debt of debt bank? He's asking.
How can we? Your voice is low. Sorry, I didn't get that.
How can we reduce the debt of benchmark company? That is his question. Oh yeah, who can try? Who can try?
You can issue share capital, sir.
You can issue share capital. Who will agree that you should issue share capital? Who will accept you to issue share capital? Okay.
So let me try and say something.
Accept, but they will not accept for debt. Yes, go ahead, please.
Okay. I feel that even though the company is they are high on debt, but the company is still doing well. And aside from that, debt is the interest on debt is tax is allowable. So most companies tend to go more in debt since it's like favorable to them in the long run.
Yamaka International. Huh? Okay. That means for what you said now, there is no problem with the debt. Let them leave it like that because they are doing well. And
I feel to reduce debt, maybe they will have to pay the debt they have on ground. Maybe sell an asset or something.
With which money?
They should sell one or any of the assets they have that is not generating probably full income. Okay. Yes, sir.
Please join my next class. This thing I just said now, we'll sit in our next class. I love what you just said now. We'll sell an asset. That question was examined in an SFM question. They gave three options for a debt. We're going to address it today. I like that.
Okay.
I like that. Okay, no wahala. So that man that has the question, first and foremost, I don't know what the debt is doing you. I don't know what the debt is doing you. But just in case you want to read, somebody said you should issue equity. So me, I will go with that person. So what we can do is that we can issue equity, collect the money, and pay off our debt. So it's just to reduce debt that you're looking for now. Issue equity, collect the money, pay off debt. Then this other lady said, sell assets. You can sell non-functioning assets, collect the money, pay off your debt. It will reduce your debt now. To reduce your debt. What again can we do? What again can we do? If you have money in your retained earnings, collect money from your retained earnings and pay off your debt. Maybe it's debt you want to reduce. Makes sense. Okay, so I think that is fine. It's a good question. So please, for the B part and the C part, I leave you to yourself. Okay, I leave you to yourself. Now, this very interesting question examined on that number 1 of ICANN, May 2017. It's interesting, and I would like to address. So the requirement of the question states that provide calculations which show the key performance indicators, KPIs, suggested by the board for the performance assessment of Cadence Industries Nigeria Limited, 20 marks. For ICANN to put 20 marks here, I know that it's not an easy thing to just crack. I know. So provide calculation to show what the key performance indicators suggested by the board for the performance assessment of Cadence Industries Nigeria Limited, 20 marks. So what are the KPIs that the board suggested? Look at where they suggested it to. Okay, so it's somewhere. They suggested it somewhere here. Okay. Hold on. Look at it. The board is considering using the following key performance indicators. Look at the KPI for what? Each product. Number 1 is total profits. Total profit is not a KPI. Average sales price per unit, you are going to compete for all these things. Contribution per unit, market share, margin of safety, return on capital employed, and total quality cost. These are the KPIs that I can say should provide what? Provide calculations for. Very simple. Very simple. So this is May 2017. Question 1. CADES. Let me see their spelling. CADES. I need you to stay with me. Let's read and see. Let's read and see. So don't be scared about the complexity of the write-ups. Most times they are just to scare you. The main point may be around just these parts. Okay. But let's see what we can do from here, Sha. CADES Industries Nigeria Limited is a subsidiary of a large manufacturing company based in China, CADES International. The company manufactures washing machines, table gas cookers, and refrigerators, which are being sold by the subsidiary in Nigeria. Now, demand for the company's product is growing, especially among the growing middle-class population, until recently when the company started experiencing some hiccups as a result of the economic recession in the country and stiff competition. The company is currently selling only 2 products in Nigeria. Both are types of washing machine. These are the basic product wash up, which is called wash up, and the premium product, which is called perfect wash. Now, for the basic product, the functions which are comparable with the existing local competitors' products, and for perfect wash, which has functions and features similar to a CADES product in developed countries. Story. The competitive environment in Nigeria is changing rapidly. Apart from CADES, 2 other companies are offering similar machines in the market. One of these has a factory in Nigeria and is producing machines similar to Wash Up to compete directly with CADES. The government of Nigeria has supported its new entrant, its tax holidays, as its product has been approved as a pioneer product. Abosha. Professional students, what do you mean by tax holiday and what do you mean by pioneer products? Before we continue. Professional student, tax holiday and pioneer products. What does it mean?
Tax holiday is a period whereby the government gives new company not to pay tax until after 3 years.
Okay. What about pioneer products?
Pioneer product, if they are doing a particular product for the first time.
Okay, you're using English to interpret the pioneer. I like that. Professional student, have you done pioneer legislation in advanced taxation?
Let me try. For pioneer products, let's say a company that is just starting, you just start the business and is your first product, you need to write to the appropriate authority that is a new business, usually maybe some products, a particular product. You write to the tax authority, is a new company and this is a fresh product. So they will give you a period of time. I think it's 3 years or so. Then you won't pay tax on your products.
Okay. Does it only apply to new products?
That was what I said. So a new company.
No, sir. If the company is also changing its line of business to another line of business, they can also apply for the pioneer product from the authority.
Okay, I will accept whatever you have said. That will be examined in advanced taxation, pioneer legislation. Okay, but tax holiday, even is few students should know what a tax holiday is. Okay, and you have answered it good. That's fine. All right, so the other competitor is now considering building a manufacturing plant in Nigeria to produce more highly specialized washing machines similar to CADES Perfect Wash. Now, CADES International stated mission is to be the leader in the industry. The board of CADES has set the following critical success factor for CADES Nigerian subsidiary. Number one, to be the market leader. Number two, to maximize profit and share others' wealth within acceptable risk, and to maintain the brand image of Cades as top of the range product. What do you mean by critical success factor? Who knows it? Critical success factor. What does it mean? Anybody?
It means their uniqueness.
Nope. Nope.
The factors to the things to do to achieve the goal, maybe company's mission and vision, be project goals.
Okay, so you have one bottle water for you there. That's a critical success factor. The major things, the key things that you should do or that will be done to achieve the success of the organization. That's critical success factor. So as an ICANN student, there are different things that can determine your success, okay? But those key things that if you do not do it, your success is very, 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 it will blur, okay? We'll move it. The ones that you need to do, that's the critical success factor. So let's take an example. We know that you are supposed to study, okay? Attend lectures, physical lectures. You can also attend online lectures, buy study materials, buy past questions. These are the ways, attend marathon class. These are the ways that can guarantee your success. But above all, there's one critical success factor there, that is study. If you like, buy material. If you like, attend lecture, physical and online. If you like, buy past question. Okay, if you do not study, you cannot pass. So that is the most critical part, the most critical success factor among all the success factors. That's why we call it CSF, critical success factor. So for this company, they have 3 critical success factors. Okay, makes sense. All right, so if you can see, everything that we have been saying here is stories. It doesn't really concern me. So let's go. You have been employed by Cades as its performance management controller, and the board of Cades International has requested that you provide calculations which will show the various indicators suggested above, and then assess how the key performance indicators will address issues in the external environment in Nigeria. The data given in Appendix 1 below has been collated for your use. So as I've said, these are the performance indicators here. Okay, we have the total profit, average sales price per unit, contribution per unit, market share, margin of safety, return on capital employed, and total quality cost. I'll give you the formulas for all of them. So what do we have here? We have, they said, Nigeria subsidiary information for the most recent financial year. This on, okay, material cost, labor cost, overhead, distribution, quality. So this is a fixed cost, admin expenses, distribution cost, quality cost, marketing cost. Other data, revenue, capital employed. We have the total market size, and we have the Cades sales in units, okay, millions units. The allocation of fixed costs are based on a recent activity-based costing exercise and are considered to be valid. No wahala. So let's compute those KPIs. What's the first KPI there? So calculation
total profit
of KPIs. Number one will be what? Total profits. Total profit. What's the formula to get total profits? Performance management students. Financial reporting students. Tell me now.
Sales minus cost.
Okay, so we'll say total sales, or let's make it total revenue minus what? Total cost.
Total cost.
So don't forget, the total cost is made up of what? Variable cost plus cost. So we're going to do for workshop, because they gave us for 2 financials, 2 products. So let's do for workshop. And let's do for what? Perfect. Hold on. Workshop, perfect wash. Workshop. Perfect wash. And let's get the total. All right, so how do we get the total revenue for workshop? I think they gave it for us. Check this guy. You get it? So revenue. That's revenue in millions. You see it in millions. So we have 44. Please let your own be in millions too. Let your own be in millions. You get. Put yours in millions. So I can have 44 what?
800.
800. And I can have what here? 30.
800.
And I can have the total as what? 75.
35.
600. Thank you.
600.
So let's less our costs. Less costs. So we said our cost is made up of what? Variable and fixed. I mean. So let's get our total variable costs. Variable costs. How do we get our variable costs? Do I do it with me that look at the variable cost here? We have material, okay? Material, labor, overhead, and then quality, and they are per unit. Just help me out. Let me add up, please. Somebody should add up the one for perfect wash, please.
For workshop, it's 25,500.
25,500. You get. So we are going to multiply it. Hold on, please. Hold on, please. I'm coming. So we have 25,500. I'm going to multiply it by what?
Fixed cost.
No.
Multiply or add?
You are going to multiply it by the quantity. Okay? Because this is variable cost per unit, 25,500. So you have to multiply it by 1.12. 1.12. So what do we have? Accounting.
28,560.
28,560. So it's a cost, put it in bracket. We'll do the same thing for perfect watch. Perfect watch, what did you get here, please?
That's 2.5.
32,500. So help me multiply it by 0.44.
14,300.
14,300.
14,300.
Yes.
Please, you know I'm not doing the workings, so it's only this one I just did workings. So you will not ask me again, how do we get 14,300? You can be jotting it too. You'll be jotting the steps. Okay, so help me add up the two. Let's see the total.
42,860.
42. All right. Thank you. So now let's move to the fees cost. Total fees costs. Who can help us for that? It's already here, I mean. So can somebody add up here and add up here?
For perfect wash, 12,000.
Okay, 12,000.
12,000.
Yes, sir.
And it's the same thing.
Yes.
So for fees cost, you don't need to multiply now by quantity. You understand that? It doesn't change. That will be 24,000. Oh yeah, can somebody give me the final answer? That's all. That's our total profits. Just say this minus these two. Sales revenue minus these two costs. Revenue minus these two costs. That's what you will do.
For the total perfect wash.
Perfect wash. Okay. 4,500.
Yes, sir.
For total, uncle.
8,740.
For the other guy. Workshop.
4,240.
Thank you. So we are done with number one. Let's go to number two. Who can tell me the next one? What did they say? Average sales price per unit, I mean. per unit. Who can give me the formula for this? Who can give me the formula for average sales price per unit? Who can give me?
Okay. Total units. Sorry.
Sorry there.
No,
Total sales divided.
Total units.
Total revenue divided by total
By
units.
Sales in units, Abi?
Units sold.
Thank you. Correct. Anyhow you put the word, just pass the information. That's it. So let's go again. We'll do for workshop. We'll do for perfect wash. And we'll do for total. So what's the total revenue?
Total revenue, 75.
No, now 44,800. Yeah, this is 75.
Okay.
Don't forget, you look at it now. Let me show you.
44,800, 3,800.
44,800. Then we have
4,800, 3,800.
So it's the total that you are giving me 75. Okay, so who can give me the quantity now? The sales in units.
1.12.
1.12.
Thank you. 1.12 and what?
0.44.
I don't even need this total. Yes, figure me.
40,000.
Yeah, I mean 40,000. Yeah, uncle.
70,000.
70,000.
Is divide, Abi?
Yes.
Okay, let's do number 3. What's number 3? Contribution per unit. Okay. So how do we go? What's the formula?
Unit sales minus variable cost per unit.
Okay, so sales per unit minus what?
Variable cost
per unit. So let's do for workshop. Workshop and perfect wash. So what's the sales per unit? Who can do it? Sales per unit. Who can compute it and give me an answer?
Total sales divided by number of units.
Abi?
Yes.
What we did here? 40 and 70.
Yes.
Do you understand what we did here?
Yes.
Average sales per unit. That says so 40 and what? 70. What's our variable cost per unit?
25,500.
Abi, thank you. And what? 32,500. Oh yeah, help me minus. That was your contribution.
14,400 for workshop.
14 what, sir?
14,500.
500.
37,500.
37,500.
What's number 4? Number 4. Market share. Is that not it? What's the formula to calculate market share?
Okay. Okay.
You know the market share of Dangote in the cement industry. You know the market share of so company in that industry. What do you do? Sales in units.
Share. Okay.
Divided by what? Market size in units. Market size in units. Okay, then you multiply it by 100. So let's do for workshop. Workshop. Let's do for perfect wash. And let's see if we can get our total. So what are sales in units?
40,000.
It's not me and you.
Okay.
Not me and you.
1.12.
1.12.
0.44.
0.44. You can add up. Then what is our market size in units? Market size.
Okay. 9.33.
9 point what?
33.
And what? 1.
1.33.
Oh yeah, divide. Put it in percentage, please.
%12.
Yeah.
Okay.
That's 3.1.
Yes. Next 1.56 now 10.66. What do you get? Okay, number 5.
14.6.
14.6, that's 15%. Okay, that's clear. What's the next one, please? Margin of safety. Wow, kabasha. Margin of safety. What's the formula for margin of safety? Who knows it? Who have done CVP a year? If you have
break even.
CVP.
Break even plus I'm trying to remember.
Oh, yeah, remember.
Break even plus
Actual sales minus break even sales over actual sales.
Okay, so that's budgeted
Times
sales.
100.
I mean, budgeted sales minus break even point in sales.
Over
So let's do for workshop. Let me do it here. Workshop. Perfect wash. And then total. So what do we do? What's our sales? What's our budgeted sales? Budgeted sales is the sales given to you in the question. 1.5 to 0.44. That's the sales. Okay. Sales units. 1.12. And what?
0.44, 1.56.
So what is our no need? What is our budgeted break-even sales? What's the formula for break-even sales in units? I'm calculating in units. I don't want to use in value because that one will be very stressful for us. We need to start calculating contribution and the likes. Anyway, we'll still calculate it. What's our break-even point, break-even sales in units?
Selling price.
Okay, that'll be fixed cost, I mean. Contribution per unit. Isn't it? You remember? Oh yeah. What's our fees cost? I think you guys gave me 12K here before. I think so. So that'll be 12,000 divided by our contribution per unit. What is contribution? You guys gave me
selling price minus variable.
Yes, selling price minus variable cost is equals to contribution. Have we done it before? Contribution per unit. Abina, this is it.
Yeah.
14.5 and 37.5. Abi?
37.5, yes.
Oh yeah, now 14.5. Thank God. Oh. Yeah, first give me this one. What's the answer? And then 12,000 divided by 14.5.
Are we multiplying? Is it in percentage? Oh, no. It's in units, sorry. 0.83.
So this first one is 0.83. So 0.83. Okay. Then what about this one?
Zero point 0.32.
0.32. So give me the answer. Don't forget the formula. Projected sales and break-even sales. This is your projected sales in units, and this ones are your break-even sales in units. You can put it in bracket if you want.
0.29 for workshop.
29. Next.
0.12.
0.12 for perfect wash.
Okay. Okay, this is number 5. Is that number 6? Number 6.
Yes.
Return on capital employed. Formula me. Formula me, please.
So capital employed.
Net profit over capital employed. So let's do for the both guys, Abi.
Yes, sir.
So let's do workshop. Perfect wash. And it's total if you want to. So what's the net profit? Were we giving? They should give us to. They did not give us. Have we done it before? Let's check. Have we done net profit before?
Net profit. No, we've only done capital employed.
No, look at now total profit.
Okay, we've done net profit.
You see. So 4240, copy it. 4240.45. 4240.45. Let's go. 4240.45. Okay, so what's the next guy? What's capital employed?
It's 2600.
Here is the guy. Okay.
560 and 91.
Where do you see that one? Look at capital employed though. Is that not it?
Oh, 32.
And now 32.6 and 25,000. I mean now. This will was 57.
Then 25,000.
So you are dividing, oh.
Yes, sir.
Please help me do this guy. 4240.45. What did he give to us? 9 what? 8740, I mean.
8740, yes.
Oh yeah, figure me.
Workshop is 13%.
13%. Rows. Which one again?
18% for perfect wash.
18%. Then the last one will be what?
15.2%.
That's 15%. For those of you that will be thinking in your mind that why don't you just add 13 and 15 together to get that? My God will help you. Okay? If it's in your head, please wash it out. So, is there any other one? Total quality. Do we know this one? So quality costs. Total quality.
It's given in the
total quality costs. What's the formula for this?
quality cost shop quality cost of perfect water.
This one, I know. Okay, they say we get total quality cost. So quality cost per unit, that's what we'll do now. Quality cost per unit. Multiply by what? Total sales, have we? Sales units. So let's do for workshop. Then let's do for perfect wash and total. So the quality cost here, 2,000 and 3,000. So total variable. Okay. We have another quality cost. That makes sense. So for the total variable cost, it will be what? 2,000, Abi? Multiplied by what? 1.12. Figure me. And the other one will be what? 3,000 multiplied by what? 0.44. 3,000 multiplied by 0.4. Help me.
2,200.
Which one?
The first one, sir. 2,000 times 1.
2,000 times 1.12.
240.
Okay.
Then 1,000.
To give us what? 3,000 times 0.44.
1,320.
Okay, so we've done the variable part. Let's do the fixed part. Okay, so the total fixed cost. What did they say about it? Where's the guy? 600. 600. Okay? So there's no need to begin to multiply. 600. So this is what 1, 2. I mean. So please add them together. That's the total quality cost.
Second one is 1,920.
One what?
920, sir.
So let me do this guy. Everything here on that total.
That's 470. 4,760.
760.
Yeah.
Okay, is that what that? We are done. No? How do you see the question?
For most of these ratios, apart from the return on capital employed, like this total quality costs now, from the notes that were given, they didn't state it there.
No, there's no textbook that is complete. And I've told you, there's no textbook in the world that I have read that has all the ratios. Case study students will testify. Some kind of ratios that they ask case study students that relate to supermarkets, that relate to banks, that relate to insurance companies. It's not what you will see in one textbook. So don't think that the ratios that you saw that I gave to you in that note is the whole ratio that we have in the world. No. Even you can improvise a ratio by yourself. So we have a lot of ratios. But determine sales per unit. All those things are what you already know. Contribution per unit, they are normal things that you know. Average sales price per unit, they are things that you know. Total profits. So they are indices. Okay. Margin of safety. If you do CVPA, you will know margin of safety. Then rows, you already know rows now. Return on capital employed. That's all now. Then it's only this quality cost. Check your PM material. You will see quality cost as a topic. Do you know that?
Yes, sir.
Okay. So these are the things they want you to calculate. All right. Is there any question? That is the end with my class. So with for ratios.
President, I have a question.
All right.
Okay, so I wanted to ask, fees cost, is it part of the total quality cost?
Check now. Is there now? Look at and this is the total. So you add both. Any other question?
Dr. President, please, can you please scroll up to number 5?
Number 5. Any other question?
Sir. Hello, sir.
Yes, sir.
Sorry, please, can you help us throw more light on that quality cost? What I'm trying to say, what are the composition of quality costs compared to variable costs now? We know that variable costs comprises the material, labor, machine, all those stuff. What are the composition of quality costs?
After I have told you that you check your PM material, you see quality costs there. I should now still throw more light. When this particular class is not a quality cost class, just note that money that you spend to retain quality of a product is quality cost. And in this case, they say you calculate the total. So add the ones that are variable and add the ones that are fixed together. This is not a full class on quality cost. I'll begin to explain those things to be boring to other people that does not need it. It's a combined class. So let's do that at PM.
I think so.
All right. Any other thing? Ladies and gentlemen, I remain Dr. President. Thank you for your time and thank you for staying with me.